And Rick, you followed up with a question. Do we expect the same results with parity trade? In a sense, yes. But remember, I'm just looking at the midpoints here. With out of the money bull puts, your bid-ask spread is going to be smaller. It might only be 20 cents, 30 cents, or 40 cents. With the same in the money bull call debit spread at the time, whether it's close of day or during the day, it might be 3, 4, or 5 points. We're basing our numbers on the midpoint. Okay, we're basing the short option midpoint here, long option mid, 70 cents, but we might have only seen a bid of, let's say, 430 to 460. The same debit spread for the August 5560 call. Oh, let's just take a look. This was on August 20th. Aug 20th, 5560 call for 21 August. Let's just take a look historically. Okay, so we got to take a look at both, don't we? Just to prove my point. I'm sorry, not to prove my point, but to prove what I'm saying. Let's go back. Let's just go to the chain for SPX. It's going to take me a little bit to load there. And I'm sorry, we're going to go back to August 20th, Rick. That's what I said, August 20th. There we go. And August 20th for August 21st. There we go. And we were looking at, so this is the historical data of all the options. Let me pause the screen real quick so you guys don't have to track with all the scrolling. So I got to get to that 5560. It's not as bad as I thought, actually, but it is significant. The 5560 call for the 1 day out expiration, Rick, bid of 42, ask of 43.60. Not bad. It's $1.60. It's much less than I thought. But wow. Got it perfect. I didn't even know that. That was just a guess. The put, 430 bid, 460 ask, 445. That's what you expect to see. In my opinion, as a parity trade, Rick, would getting the midpoint at the 55.60 with the same 5-point spread here, the 47.15, and that bid-ask spread is only $1.50, so that's just as well, versus 15 to 20 cents. 30 cents. I'm more likely to get filled at the midpoint here with the out-of-the-money credit spread, in my opinion and in my experience, than getting the good midpoint I want on the debit spread with the wider bid-ask spread. That's just my opinion. But parity-wise, you're correct. If I got the midpoints here, 42.80, 47.15, that would put us at a debit, of course, of about 4. Wow, that's terrible, isn't it? Am I doing the math right in my head, guys? Check me on this. Aren't I at a debit here of 565? It's not 465, it's 565, isn't it? 47.15 to 42.80. No, I'm wrong. I am wrong. Okay, so it would be 465, so it would have been a 15-cent profit on 465. Our net credit here, remember, was 70 cents against 430. So this is a good point to bring up here. I would have gone with this night and day, if my math is correct. So midpoint, if we got it, which I think is likely, we would have had a 70-cent net credit here on the bull put credit spread. Here, we would have had the debit of 465, it looks like, for only a 15-cent profit. On that note, very quickly, when you're doing your search, I'm going to do a live search again. We're going to go back to our live search for bull put credit spreads on our SPX 0-day, ladies and gentlemen. And I have to extend it again to 4 days just so we can see it. When you're running your search, Rick, for bull puts or bear calls, depending on where your market's going, or even if you want to do debit spreads, hey, I've got my spread here, August 55.80, 55.75, 5-point spread for Monday. I get a 38-cent net credit for max risk of 463, 8.1% return with an 80% probability. Talked earlier during the opening of the presentation, how you compare risk and rewards. When I'm looking up any search, once I've identified my position, position I'm interested in, I'm going to go to the midpoint spread chain. It's one of our signature tools, and it defaults here. I have it spread width of 5, minimum 7% return, 75% probability. This is a separate tool, but look at the categories. I can look at just credit spreads, so it show me bear credit spreads and bull credit spreads. Good idea to use if you're building an iron condor. Debit spreads for debit condors. You can see them side by side. Or put credit and call debit parity. And the reason why I went here is now I can compare side by side. If I get midpoint on our bull put, highlighted in red for us, we saw the net credit we got of 33 cents and a return of about 7% at midpoint. Okay? I'm sorry, return at midpoint. There, we have it 8.2% with an 80.3% probability. Parity-wise, the bull call debit would be an 8.7% return. Well, that's better. I'd go with the debit spread. Now let me take a look here. 59.50 to 61. That's not too terrible. 54.80 to 56.30. Okay, can I get this midpoint here for that debit of 470 for a return of 30? Or at midpoint, the spread would cost me 460 for a return of 40 versus 38. I'd try it. I use this spread chain tool daily. Oh, not daily, but every Monday when I'm opening my bull puts or my bear calls based on that market sentiment, Rick, I find the bull put credit spreads I want that match my weekly default settings that I prefer to use, and I come here to the spread chain, and if I see a glaring difference, here's one. It's only a 75.6% probability. The 55.90 put and buying the 55.85, 5-point spread again, 52 cents, 11.6% return. But the debit spread at midpoint is 13.6. It's 2% higher for a daily trade. Okay, 3-day trade in this case. But you see what I mean? If I see that discrepancy, absolutely. I'm going to try to enter this spread as the debit spread. And if I don't get filled in the first 5, 10, 15 minutes, I'm going back to the credit spread with a lower bid-ask spread to get filled on that. Most of the time, I jump into the credit spread as I originally looked for, Rick. That's just me personally because that's my preferred strategy, my preferred approach. And we talked about why I prefer the credit spreads over the debit spreads. But it comes down to buyer's preference. But this spread chain tool, very powerful. Found the spreads that I wanted on my search for my 0 data expiration positions. Yes, I know, it's for Monday, it's 3 days away. But once I've identified them, I'm going to go to that spread chain tool. I may have to adjust some criteria to match the spread width I'm looking for initially, but once I do, I can compare side by side. Same strikes will have the same probability above. Absolutely, that's what makes it a parity trade. Now I'm comparing, do I think I can get midpoint to get that 8.7 over the 8.2? If I was going with the 78% probability, I'm firing away on the credit spread all day long at 8.7 versus 7.5 at midpoint for the call spread. And this one here, hey, I wanted to go down to 75%, not really in my wheelhouse that I would do. I'm going to go ahead and try the 13.6, try to get that extra 2%, bang for my buck, absolutely, Rick. And then if I don't get filled in the first 10 or 15 minutes, I'm going to back off and I'm going to go into the credit spread and try to get filled at that price. Why 10 to 15 minutes? Because you can't waste time if you're doing a 0 data expiration. You got to get the fill you want because this is decaying. Right? You know it and I know it. I waited till 9:45, 10 o'clock, 10:15 to where I felt the market was stable and I'm not chasing bid-ask spreads. I'm not chasing the open. I'm opening a spread with a good 80, 82, 83% probability I want at that time for a 0 data expiration position. And I'm going to take a look at the spread chain and compare it, but I'm already an hour behind because I wanted to see what the market was doing. I didn't want to try to enter this the day before and get caught with news that comes out over the weekend. As you mentioned, you said you had difficulty with the 2, 3, or 4 week out spreads because there's so much fluctuation in the market. And I've had good luck because I've been following my preferred criteria for the bull put credit spread weekly or bear call weekly, following the market sentiment tool we looked at as well. So powerful tools available for you. You can set up that search as we saw any way you want to look for 0 days to expiration, whether you're bullish or bearish. How do we know if we're bullish or bearish? We're going to follow along with that market sentiment tool. Our last indicators were in the buy range. That was on August 5th. when we were down to 5,186, we started to see the bullish buy and the light buy warnings. We would have triggered to go back into the bull put credit spreads. Sure, there's going to be fluctuation from time to time. In my opinion, with that 80% probability, you should still be in a good range. We saw that with that small test we did on the first day where SPX and NDX were down 0.2%, but all of the positions we would have opened would have expired worthless. And that was the lower return of, what was it, 7%. And then the next day, Tuesday to Wednesday, again, just using closing prices, it was about another 100% success rate on the bull puts with about an 8.5, 8.6%, if I remember correctly. Management on those is a different story. You might find some of those available in the questions and answers there on some of those other videos. But my approach to manage a bull put credit spread, bear call credit spread that I'm in with a 0 day to expiration would probably match the same approach that I use for managing a bull put credit spread if I'm 2 to 3 weeks out. And again, something for you to check out later. Just go ahead in that search as well. In addition to 0 days to expiration, of course, you'll have this recording available for you sometime tomorrow. Just type in a search on Power Options in the magnifying glass search there for 8 ways. You have 8 ways to manage a bull put credit spread. It's an hour long, but there's also some reviews here. 8 ways almost. We talk about it there. 8 ways to manage a credit spread. It's only 19 minutes long. It goes through some of those. But I would use, based on what the market's doing, I would use those. But one thing is absolutely key that you'll see in these videos is managing the loss. If any spread I'm in, whether it's a 0 day to expiration, my 2 week out spreads, whether it's an iron condor, a credit spread, or a debit spread, I am most likely closing the position if at any time the position hits a 50% loss of the maximum risk. I am just out. And the reason why, we have a tool that we offer at our sister site, our partner site, radioactivetrading.com. In the resources view here, the trade simulator tool, you can plug in what your target return is. Let's say for that 0 day to expiration, we're at 7.5. I'm going to keep the loss limit to 50. And I'm going to put in a success rate or a probability of loss of, let's call it, that's 15. Okay, so 85% success rate. Now, if I'm right only 82 or 83% of the time, you see I'm losing money. And this is because it's a lower target return. But at the target range of 85, 90%, we're doing fairly well, but we may drop $10,000 down to 50%. Okay, I'm using about 50% invested into each trade, of course. 83% is bad. I want to get to 86, 87 out of the 90. Well, I'm sorry, Rick, what it's doing, we're flipping a coin 100 times. Heads we win are 7.5%, tails we lose. But I want to, there we go, 85 now. I want to be profitable. I got to get to 86, 87. Wow, it's that high. All right, let's stick with 89. This doesn't look that good. It's only a 10% return after 100 trades. I get it. I'd probably have to adjust the loss limit, in my opinion, for these 0 day to expiration positions. But 89 win rate, at one point you think you're doing extremely well. You've got almost a 65% return. Have a 30% drawdown, which isn't terrible. It's expected with credit spreads, right, over time. And then eventually a 12% return. Not what you're looking for. And I think the reason why is because normally what I'm getting with my bull put credit spreads the 2 weeks out is we're averaging about 14.9% on the winners. And we're right about 87% of the time. So I'm going to put it about 86% of the time. And we open about 3 trades. But what I want to see, even here at an 82% success rate, we're taking $10,000 and almost doubling it. But we have almost a 50% drawdown at one point. All right. So now let's get up to where I want. These are too high. I want just, come on. It's random. All right, we're going to stick with 88. Nah, that's too high. We'll stick with this 83, okay? 50% drawdown at one point, almost more than tripled our money at one point, ended up more than doubling our money at one point, starting with $10,000, targeting 14.9%, 83% win rate. Let me write that down. 17 losses, flip of a coin, heads we win, 14.9%, tails we lose 50%. What if I just move this up to allow a loss of 65%? Look at that, 87% win rate. I'm only at $3,000 higher. Let's try to get to 83. I'm losing money. down 1,200. This is for the 2-week out spread, Rick. This is what I'm targeting for the 2-week out. You're not going to target this with the 0 day to expiration. You're more looking at along those lines of the 7.5%. And in my opinion, to be successful, let's say that we're at 85% probability on our search. I think you've got to keep the loss limits down to about 35 or 40%, which is tough. So a 5-point spread, I collect 33 cents. My risk is 467. So that means if the loss is a third, if I get to a point where the spread I'm closing out and the loss is a third of the maximum loss of 467, I have to close out the trade. And this sort of plays out what we were talking about. Okay, now it's 100 trades, so over 100 days, heads you win 7.5%, tails you lose 35%. If the market goes against you sometime in the mid-afternoon, you get an 86% win rate. At one point, you got a 60% return on your portfolio, end up with about a 50% return. But yeah, at one point, you're down 20%. That's just the nature. And why am I using 7.5%? And that's because kind of what we're seeing here now. But on the 0 day to expiration, it might be a little bit lower. But even in our back testing, we were seeing 1 day out trades with 9, 10, 11% returns. And it's end of day. I know that. And it's no guarantee of future prospects. And what we're showing here on the trade simulator tool is no guarantee of future prospects. What this helps you do is set your targets for your trading plan. Okay. Hey, I'm seeing on average that I'm making 6 or 7% with an 85% probability on 0 day to expiration spreads with my criteria. Where do I have to set my loss limit if I am right that 85% of the time? Let me put $10,000 into this. I might only open 1 trade. I might open 3 trades, but it gives you a gauge now of expectations. But hey, what if I allowed the 50% return with that same 86% win ratio? We saw that earlier. It was still a loss, right? I'm down more than 50% with an 84% win ratio. Still 50% at 85. 86 was about the same. We did see that number, so I get to sit here and click it, but I don't think I'm going to hit 86. There we go. 35%. I'm down 35%. At one point, I was up 20. That's not going to be effective with a target range of 7.5% for a 0 day to expiration spread. This is going to have to be down to 35. And you might close out more positions more often. That's always a trigger. But that's what you can run into.